Thomas Costerg, European economist with Standard Chartered Bank, joins us live in the studio. Welcome to First Look, Thomas. And first things first, is 800 billion euros big enough for a firewall?
Well, it may be probably not big enough to cover Spain and Italy should they go into more difficulty. The true firewall is the ECB. The 3-year LTRO provided 1 trillion euro, and that's what the market wants to see.
So we've already seen that 1 trillion euros in unlimited 3-year loans was what was on offer. 1 trillion euros is what has been provided. Is that going to start flowing into the real economy, though? Are we starting to see banks lending to companies?
Well, so far it's not flowing into the economy. That's the problem, because you see, in fact, credit is not flowing to corporates, not flowing to households, and that's a big issue. In fact, we're seeing this ECB money flowing into sovereign bonds, but not into the real economy.
You go, David.
Well, I also thought one of the interesting things, there's an article in the Financial Times today, which is talking about, and this comes from after UniCredit's profit that came out last week, they're talking about actually beginning to repay some of this LTRO money before 3 years, in fact, as soon as after 12 months. I'm just wondering what your reaction is to that and how the markets might perceive that, given the fact that people are worried about when the ECB is going to be able to start to exit these measures.
No, it's a good point. In fact, if you look at a bank's balance sheet in Europe, they're at record high. So the deleveraging has not started. That's the problem. Balance sheet have ballooned across Europe. And so, in fact, if you want to see balance sheet shrinking, which is the aim of regulators and politicians, then they have to probably repay this liquidity back to the ECB.
And the ECB, will it step in again? Will it be forced to? You said the 800 billion euros won't be enough if we do see Spain and Italy getting into more problems. Do you expect another round of 3-year loans being on offer to the banks, or really is that a last resort?
Well, we think GDP will continue to contract, especially in the second quarter. So we see growth will continue to weaken, and so probably the ECB will first cut rates to 0.75, we think.
Okay.
And then if the crisis escalates and if banks need more liquidity, we think the ECB would have no other option than to provide another 3-year LTRO.
Now look, in terms of the crisis, I mean, we've seen the firewalls have been put up, the IMF is the next step. How do you see the policy towards coming to an end game for this crisis evolving?
Well, you have this issue about Eurobonds, but some Northern European countries are still not ready to accept this idea. And why? Because it's taxpayers' money. We have to bear in mind that it's taxpayers' money, and that's why maybe Germany wants to limit the bailout fund at 500 billion euros, because they don't want to compromise on their AAA rating. That's key.
Already we've seen France is in concern overall, but what about the other economic factors that we're having at play here? Because you say you're going to expect a contraction going forward for the European economies. Is oil a big concern here? Because we are seeing the price just continue to stay very elevated.
Yeah, you're right. I have 3 concerns, in fact. First, confidence is not back. Then credit is not flowing to the economy. And then you have austerity measures. And I would say a fourth thing is oil prices. Oil prices are at a record high, especially if you look at in euro terms. They are at record high, and that's weighing on growth.
So still many a hurdle to jump at the moment, despite what we see as a bigger hurdle, a bigger firewall of 800 billion euros. Let's get on to the PMI figures, because Italy, France, Germany, Bloomberg survey seems to think that we're still going to have a contraction for all 3 countries. When do you think we might start to see some sort of expansion?
Well, in countries like Spain and Italy, austerity will continue to weigh on growth. For instance, if you look at Spain, all the austerity measures that were announced on Friday will start to kick in gradually, but mostly after July. So in fact, we will continue to see weakness in these countries, especially in Southern Europe, so for a while. So I'm afraid we might continue to see PMIs below 50 for a certain number of months.
How about Germany, though? Because actually you said you see Germany remaining the best in class, being the driver for growth. But still you're expecting actually a fall in industrial production later this week when we get that sort of data out. When do you start to see a bit of a rebound coming from Germany?
Well, the problem with Germany is that they depend on what's happening in the rest of Europe, but also exports to the global economy matters a lot as well. So if you see global trade decelerating, this might affect Germany as well. But as you say, we still see Germany remaining best in class, and so we see a positive GDP this year in Germany.
What's an interesting trend coming forward at the moment is what you deem to be political risks. At the moment, we've got elections coming up in France. Indeed, we're having also in Greece, could be as well as soon as this month. Are investors at the moment factoring in these political risks enough?
You're right. There may be some sense of complacency about this political risk, which is going to rise, especially in Greece. We have key elections, and it's not sure that the parties will all support the European bailout. So that's
the austerity that they have
the austerity, the bailout, all the measures. So that's a key risk in Greece. But we have also elections, regional elections in Germany, elections in France. So I mean, the political risk is really a big risk in Q2, yeah.
But if we do see François Hollande winning in France, say, as at the moment he's on set to do you really think he could move away from the austerity measures that France have said, that the amount of deficit cutting targets that they have in place?
No, you're right, and there's not much room for maneuver. Probably each candidate will be very pragmatic, and when it comes to the office, he will have no other option but probably cut spending, raise taxes, so as to remain on target with regard to the budget deficit.
And how about unemployment? How much of a concern is that? Because later today we get figures out on unemployment for the Eurozone. You expect 10.8%, which is a bit of a rise from the month before. When are we going to see a turnaround in hiring?
Well, that's the difference between the US and Europe. The Fed is very concerned about unemployment, and in Europe, it's only inflation. So that's the key difference between the US and Europe. In Europe, I'm afraid unemployment will probably continue to rise, with still a lot of differentiation between the north, especially Germany, where unemployment is at a record low, and the rest of Europe, especially southern Europe, where unemployment is in sometimes in double digits.
And Thomas, very quickly, with the US overall, you are seeing a divergence. We are seeing better data on the whole in the US. It is setting its sights about. Is that going to hurt the euro going forward? Are we going to see the euro really weaken in comparison to the US dollar?
Yeah, so our forecast is for the euro to weaken in Q2. As you say, there's a growth differential, so growth is underperforming in Europe. There's also a matter of liquidity. The ECB injected a massive liquidity with the 3-year LTRO, and we think this will weigh on the euro, especially against the dollar.
We're certainly down a little bit today, so it could well fall further. Thomas Costerg, thank you very much. European economist with Standard Chartered Bank, here with us this morning, discussing all the issues of Europe and, of course, that firewall.